how are you thinking about, what's the follow through, or what's the next, especially as this comes out? I guess my point is regulators were aware that there was stuff going on. So was it that the systems weren't in place, people weren't listening? Where did it break down?
Yeah, so that's a fantastic question, and definitely something that we'll be learning more about in the coming weeks. The Fed itself has promised to investigate its own supervision of Silicon Valley Bank and publish the results by May 1st. So I will be very excited to read that when it hits and report on it in the meantime.
Carol and I were actually just talking about, as far as going into this weekend, just thinking about what transpired last weekend. Where are we at heading into the weekend, Herman, as far as should we be prepared for potentially other headlines to come through?
Well, I'll be on my Bloomberg terminal at 7 o'clock on Sunday just waiting for something to pop up. So I'm anticipating something. I don't know if we should expect it, but we just should be vigilant in terms of something coming out of First Republic or from the regulators. So that's something to watch.
Well, and what's interesting, Hannah, just to bring you back in here, I'm looking at your story. The San Francisco Fed had a program, right, for overseeing regional institutions. So they were on it.
Yes, that's true. But the large institutions, we're talking like in the biggest example, like Wells Fargo, for example. So those are much larger, much more complex than some of the smaller banks. Which is why the more senior people are the ones in the large bank group. So it definitely, in my understanding of it from talking to sources and whatnot, and my own research, it was a different level of scrutiny once Silicon Valley Bank moved into the new group.
Okay, so that they were certainly getting looked at.
And I would say Silicon Valley was actually going to go through the annual stress test starting next year if they were around. So they just grew so fast that I think they're, like Hannah was saying, that it took some time for the regulators to come together and realize what sort of institution SVB really was.
I just feel like, in some ways, Hannah, I feel like we've seen this movie before a little bit, in that things just are kind of moving so fast and regulators can't keep up. Herman weighed in on what he's watching out for. What are you watching out for as we go into a weekend?
Yeah, that's a great question, and I'll note it's only 3:16 p.m.
Sorry.
So a lot could evolve between now and then. I'm watching all the things that we've talked about on this call. What happens with the other firms that people have been talking about, and whether there's any news on the front of what happens to, I guess, the corpses of Silicon Valley and Signature.
Yeah, and let's not forget Credit Suisse is holding weekend meetings to assess its scenarios.
Right.
Again, not all apples to apples, but it's just you kind of start to layer these things on top of each other, and this is why we are seeing stress, certainly within the banking sector and banking stocks in particular. Hey, guys, thank you so much. Different angles to the story, so we really appreciate you both weighing in. Hannah Levitt is finance reporter at Bloomberg News in our interactive, nope, she was on the phone, forgive me, in our interactive broker studios. Herman Chan, he has been a go-to for us throughout the week, and I know he will be next week as well. Senior analyst for regional banks in the United States at our Bloomberg Intelligence team. Herman, thank you so much. Really appreciate it. All right, coming up, as we mentioned, we see big banks and the regional still under pressure. We'll continue to track that trade and any headlines that come across. Carol Massar, Jess Menton, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:21 on Wall Street, this St. Patrick's Day on Wall Street. We've got this tweet from Bill Ackman saying he is hearing that Bank of America is going to buy Signature Bank on Monday. Signature Bank, of course, along with Silicon Valley Bank, was seized by regulators last weekend. So that's the word from activist investor Bill Ackman. We do not have that confirmed at Bloomberg, but that's certainly something to watch for. And shares of Bank of America, they're down 3-4%, let's call it right now. Shares of First Republic, meantime, they're plunging again today, even after that $30 billion cash injection. That company is getting shares of First Republic down, down 31% right now. Credit Suisse ADRs are lower here in the U.S. At least 4 banks have curbs on trade with Credit Suisse. According to Reuters, that includes SocGen and Deutsche Bank, worried about the counterparty risk. The Fed meets next week. A lot of questions about whether they will hike it. Right now, the Dow is down 404 points. It's about 1.25%. The S&P 500 out 42 points. That's about 1%. The NASDAQ down 84 points. That's about 0.7%. The yield on the 10-year Treasury right now, 3.39%. The 2-year, 3.82%. NYMEX crude, it's down almost 3%. 66.34 a barrel. Spot gold, it is up more than 3%, 19.79 an ounce. FedEx shares giving us some green on the screen as well this St. Patrick's Day today. And that is your Bloomberg Business Flash. Carol and Jess.
All right, Denise, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. If your business was hurt by COVID, it may qualify for a payroll tax refund. Even if you took PPP, your business may still be able to claim the employee retention credit. See if your business qualifies for ERC assistance. Just head to getrefunds.com. Well, earlier this month, Okta reported earnings that sent its stock soaring some 13%. It gave an upbeat first quarter revenue forecast. Like many tech companies, though, it is finding a focus on efficiency. It is paying off for the company. The stock, by the way, up more than 20% year to date. So let's get to it. Lots of questions for our next guest. Todd McKinnon is the CEO and founder of Okta. It's a 14-year-old software maker known for authentication services, counts Sonos, Zoom, HPE, and OpenAI among its customers. And lucky for us, Todd's in our Bloomberg Interactive Broker studio. So nice to have you here. I do have a million questions that we're going to cram into 8 minutes. First of all, Silicon Valley Bank. Tell us about the relationship you guys have had with them and how you see the situation.
Silicon Valley Bank is a key part of the tech ecosystem. It's, for many companies, Okta included, it was the first bank we had as a company. We raised our financing and we put it in there and started running the business. And over the years, the relationship.
Did you put more than $250,000 on deposit?
For sure. I mean, our first seed round was $1 million, and the next round was $10 million.
And it went in.
All in Silicon Valley Bank.
So keep going, sorry.
Yeah, and so over the years, what happens is you grow, and and the big diversification point, I think, for a lot of companies is when they go international. It's really, you have to have a big, diverse set of banking partners to pay internationally and to accept payments internationally. So that was the point of diversification. But for a company that's early in its life cycle, it was really it's a serious issue for a company that has operational.
So a lifeline for you guys are crucial, right?
Yeah, well, we've evolved past
in the early days.
Yeah, in the early days. But once you get to a certain size and scale like we are, you're pretty diverse. But it did bring back memories of when Okta was founded right after the financial crisis, 14 years old, started in 2009. So it really brought back some memories of banks failing and being that early stage of a company where you're trying to survive and trying to get product market fit. And the last thing you want to deal with as a small startup is something you trusted as being really something that could never go away, is to have a serious question about if it would be around.
Todd, no Silicon Valley Bank. What does it mean then for entrepreneurs? Like, what Todd McKinnon today do?
Well, entrepreneurs are by definition pretty adaptive,
or a different Todd McKinnon.
Yeah,
starting up a company today.
exactly. They're pretty adaptive, and they're good at navigating changes and uncertainty. If you wanted a stable, static environment, you'd never be an entrepreneur. So I think other folks will step in to fill the void, and I'm very optimistic in the opportunistic future of both the world in general and also Silicon Valley specifically.
What are your overall thoughts of this collapse as it's been playing out?
I just think it's fast. I'm not I'm running a 6,000 person, $500 million plus a quarter enterprise software company. So the last thing I'm worried about is financial stability of the banking system. So you hear stories about it on Wednesday, and on Thursday, all of your friends are talking about what they're going to do with their company finances in the treasury, and are they moving money around? So it happened incredibly fast. And it's a little unsettling for, I think, every company. When you think about your early days of a startup and what that means for other startups, when you think about potential customers you may have, partners, how you're going to, we still use Silicon Valley in parts of our business, relatively small parts now. For us, like I said, we're lucky enough to be able to diversify away and use our other banking partners. So it takes work by the team, but we're able to power through it.
Why did you decide to still have certain parts work with SVB?
Part of it's just the history of having that relationship.
Yeah.
You integrate things, you wire up payment sites, and you have payroll relationships, and it just keeps going and going and going.
I guess what gives you confidence? Are there particular segments? Like what exposure is it to there that you think it's a bit more shielded and wouldn't be happening like these other people that have had to go through these kind of deposit type nightmares?
Well, I think it depends on the company, and I think to draw two broad categories, there's companies that are single-threaded with one banking partner,
right,
and there's companies that are big enough and diverse enough to have many banking partners.
Mm-hmm.
And so I think this is really an impact for the first category, which is small companies really just trying to find product market fit and aren't diversified in what they.
So I want to talk. All right. So you reported earnings before all of this started to happen. So investors liked what they heard. They sent the stock soaring. Tell us a little bit about what you're seeing in terms of the business environment. You have customers that we all know. We know the names. What does it feel like right now out there?
It's what we do is very important for a lot of different areas of a company and initiatives that a company is working on. And we're lucky enough to be not only mission critical for our customers, but also mission critical in any economic environment. So simple example is if you're part of our portfolio, Workforce Identity helps companies adopt new technology and make their workforce more efficient and give them the best tools and give them be flexible with different working environments. So in an economic time of uncertainty or macro conditions are not clear or what's happening with the banking system, you want flexibility and you want efficiency, and you can do that with a good identity system. You can do that with access to the best technologies is what identity does. And that's just part of our business. Another big part of our business is customer identity. So we're lucky enough to work with OpenAI to be the identity, to be the login for ChatGPT. So no matter what's happening, no matter what there are in terms of economic concerns, the march of technology goes on, and there's innovation, there's amazing breakthroughs like ChatGPT, and so that's driving part of our business in that specific example. So we're broadly diversified across different types of businesses.
Is that half and half, that split?
It's the split in our two businesses between workforce identity and customer identity right now is 60-40.
Okay.
So 60% of the revenue is from workforce.
Right.
But we think over time, we're building this broad company that can address all of these identity use cases. So we want to move that toward 50-50 and have both of them be growing quickly.
I have to say, in general, I just think about what it takes every day to get into our systems. And just increasingly, I'm okay with it. I don't care how many layers, whether it's in getting into my own bank on my phone, like, bring it on. So I do feel like you're in kind of this sweet spot in terms of a business. You mentioned ChatGPT. What has changed in the dynamics of that side of the business since that Microsoft $10 billion investment in OpenAI?
Well, for our business, customer identity, it's like I mentioned, it's 40% of our revenue. And the key thing to remember about this business is it's kind of a new market. Workforce identity, there's been traditional players. You've purchased your identity technology from maybe in the past from an IBM or an Oracle or companies like that. And so we are the cloud version or the modern architecture, the flexible modern architecture for that. On the customer identity side, it's more of a new market. It's this world where developers are innovating. They're building all these new solutions. ChatGPT is one example, but this is happening in every industry: the media industry, the financial services industry, every industry, technology, of course, manufacturing. They're trying to retail. They're trying to get more closer to the customer, and to do that, they have to build websites and build mobile apps and deliver a better customer experience. Mm-hmm. And inevitably, they have to provide a login to a user, and they have to make sure that they make it easy for the user to log in, and then make it easy for the customer to map that customer, to map that user to different backend systems and market to them and progress that relationship
And track data.
and in an additional way.
Yeah.
Track data for sure. For depending on what the business is, it varies, but they want to have a great customer relationship, and that's really an identity problem. And so that's done by a developer, and our business in the emerging customer identity segment is really good for developers. It's super easy to use. The OpenAI example is a good one because 2 years ago when they started using our products, the reason they did is because it was really easy for that developer to use. They didn't know it was going to become ChatGPT, but by having a great developer experience and getting in there early, you can provide value in the early days and then as it grows and scales.
All right, got to ask you, glass half full, glass half empty right now, real quickly. In terms of the outlook.
I am a glass half full guy.
Is it just because you are, or because you feel confident about the data points that are coming down in the news?
I think there's a lot. I mean, I think in times of turbulence and times of change, the companies that can provide stability to the employees, to their customers, and provide a path through things to a better tomorrow are the ones that are going to thrive. So that's what we stay focused on.
Well, I was thinking about, Meta and Mark Zuckerberg, year of efficiency. It's making people, in terms of where they spend, certainly companies, really think about it a lot. This was so much fun. So appreciate it. Come back soon.
Thanks for having me. It's great to be here.
Todd McKinnon, he's co-founder and chief executive officer of Okta, joining us here in our Bloomberg Interactive Broker studio. As I mentioned, the stock up more than 20% year to date and definitely popped when it reported earnings earlier this month. Right now, you are listening and watching Bloomberg Business Week. Let's get a check on world and national news. Leslie Lotto's in our Bloomberg 11:30 newsroom in New York. Hey, Leslie.
Jess and Carol, thank you. Could it be that coronavirus actually did come from that market in Wuhan, China? After all, international scientists have reportedly examined genetic data not previously available. Samples came from the Huanan seafood market and may be linked to raccoon dogs. A French scientist scouring a database came upon data which the World Health Organization Director General says could move us closer to a definitive answer on the virus's origins. Decisions over the safety of medications should be left up to the FDA. That's what White House Press Secretary Karine Jean-Pierre said yesterday as a judge in Texas considered whether access to an abortion pill should end.
This is about FDA's authority to make its independent, evidence-based decision on drugs.
The judge heard arguments in a case challenging the FDA's approval of the abortion pill approved back in 2000. Jean-Pierre says the administration believes the drug is safe and it would be devastating to women to prevent access. Former President Trump's former personal attorney and fixer, Michael Cohen, appeared on ABC's Good Morning America today discussing testimony he gave this week in front of a Manhattan grand jury, currently deciding whether or not to bring criminal charges against the former president. If indictments are ultimately delivered, he'll be the first former president ever charged with a criminal offense. Cohen told George Stephanopoulos his biggest regret was taking the job with the former commander-in-chief in the first place.
I fell into it. I was working for a man who ultimately became president of the United States. And yes, there were things that we did that were wrong. For example, the hush money payment. But I never expected that democracy would be on the line.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It is 3:40 on Wall Street this Friday, St. Patrick's Day afternoon. Not a green parade on Wall Street. Also, we got that tweet by activist investor Bill Ackman that Bank of America could buy Signature Bank on Monday. We do not have that confirmed by Bloomberg, though. And now for more on everything that's going on, let's go over to the First Word breaking news desk for today's afternoon call with Bill Maloney. Bill.
And good afternoon, Denise. U.S. stocks lower as worries about the banks continue. First Republic falls as much as 35%. Dow's currently down 402 points. S&P's dropped 43, and NASDAQ is off by 92. Gold is trading higher by 59 points. The U.S. 10-year yield plunges to 3.39%. Energy is in the red, and Bitcoin is higher by 8.5%. Of the main 11 S&P sectors, all are trading in the red, led by declines in the financials and the industrials. And leaders to the upside in the Dow, Microsoft and Home Depot, while Travelers and J.P. Morgan led to the downside. In other news, Western Alliance Bank said that outflows have fallen sharply. Schwab says it got about $16.5 billion in core net new assets for the week, and Bank of America fell to its lowest level since 2020. Wrapping things up, FedEx rose 8% after earnings. Live from the First Breaking News Desk, I'm Bill Maloney. Denise?
All right, thank you, Bill. And to hear live breaking news over your Bloomberg terminal, type SQUAK GO on your Bloomberg terminal. And that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left in today's trading session, and stocks just off their lows of the session, as you just heard, watching that Treasury trade because bonds are up and yields are down on this Friday after quite a volatile week. So let's get to it with George Schulte. He's founder and CEO of Schulte Asset Management, on the phone from Harrison, New York. He's a distressed and special situations investor, which is why we knew he was a good person to talk to right now when it comes to the market environment. George, good to have you here with Jess and myself. Market volatility, bank stress concerns. We've had 3 banks collapse in the past week or two. We've got Credit Suisse. They're having meetings over the weekend about kind of what's next. How distressing is this situation as an investor, in your view?
Well, Carol and Jess, thanks for having me back. It's great to be here, and happy St. Patrick's Day to you. Yeah, this harkens back to 2008. We're seeing, one bank after the next drop, and they all seem to have the same problem, which is they were long-dated treasuries. And with interest rates climbing so much last year, all these books are worth 20 to 40% less. And so no matter what you do with a couple banks, you really have a balance sheet problem that is kind of systemic, frankly. And so, that's why we're seeing all this trouble. We're seeing it not just with regional banks, we're seeing it with, even Credit Suisse on the other side of the world. And, a lot of the big banks have exposure to this issue as well. But I think generally they did a better job of hedging it. So we'll see how this all plays out. I suspect there'll be more drama over the weekend. Maybe First Republic will merge with somebody over the weekend. But it's really just day by day. And
do you really think this is exactly like 2008? Because many have said it's not 2008.
Well, it rhymes with 2008. It's not exactly like it. Back then we had a real estate crisis. This time we
had a lot of counterparty risk. There were a lot of facets. So, yeah, I just want to be careful here as we cover this. We know, the banking sector has certainly been under stress, but do you really think it's like 2008?
Again, I think it rhymes with 2008, except this time the problem is treasuries, of all things, that are worth a lot less. Last time it was the real estate market, was worth a lot less. And then there are, of course, derivatives. That's behind us now, but it's a different kind of problem. And it really rhymes with 2008. We'll see how it all plays out, though. And I think the next couple of days will be exciting for bank investors. Look at these stocks going up and down like crazy, and then one bank after the next ultimately is going out of business. So it's really kind of shocking, I think, particularly for equity investors.
Can you set the scene for us and take it back either the last month or so? What sort of warning signs did you begin to notice, if at all, leading up to this past week with all of this unfolding?
So I think it's pretty evident, and I think it's been pretty evident to investors and bank companies that their books were underwater. You know, what was a bit of a surprise is how rapidly some of these regional ones just disappeared. For instance, you know, Silicon Valley Bank trading at $267 a share, next day trading at 105 at the close, and then just never opening again. That was shocking, I think, to most people, and you know, I wish I had known before. But you know, I think if you did your fundamental analysis, if you looked at the balance sheets and read the footnotes, you know, it could be pretty evident, you know, a long time ago that they were underwater. And so it's just a question of, you know, how are they going to manage this and do they have liquidity? So throw on top of that excessive leverage and deposits that weren't insured, and you know, you created sort of a powder keg here with a run of the bank. But I don't think the regulatory and commercial measures so far, you know, have really solved the problem yet. I think there's still, you know, a couple more shoes to drop, I would say.
So have you in the last week made a trade based on what's happening right now?
Yeah, we have a number of trades. We've actually sold off our remaining long positions that we had in banks from, you know, the 2008 credit crisis. But actually some very interesting new shorts with some of these companies, some of these regional banks.
Is First Republic among that short?
Yeah, I think at this point, I'd rather not name specific companies.
Okay.
But I do think on the long side, you know, there's certainly a trade to do with precious metals also. I mean, you know, with all this uncertainty, you know, maybe you're not at the point of extreme counterparty risk, but, you know, there's certainly a flight to quality. I question whether this time around the flight to quality in treasuries really makes sense, because that's sort of the, you know, ground zero for the problem. But I do think precious metals make sense. It's kind of surprising to see Bitcoin rally, you know, but it's acting as another safe haven asset right now. Even though last year when FTX failed, we kind of had the Lehman moment for crypto. But it's interesting to see that rally as well right now.
Are you seeing more money coming in from investors the past week, just given this type of situation?
Into where?
Well, into when you're talking about like the distressed debt, as far as, do you see investors wanting to come in if there are those concerns and they want to change those types of trades and maybe go toward that corner of the market specifically?
Yeah, it's certainly, I think it's certainly going to become a much more popular, you know, area for investors, because, you know, there will be and there are opportunities to buy things at very attractive prices because the sellers are forced sellers, and, you know, the situation is highly uncertain right now with litigation and regulation and, you know, a changing environment. And I think that's why you've seen, you know, first of all, you've seen deposits flee, you know, the shaky banks, but you've seen some, you know, pretty astute investors come in and try to buy the pieces, even the deposits for some of these banks before some of the latest regulatory measures were announced. But yeah, I think for a distressed securities investor with a nimble approach, for instance, like Schulte Asset Management, with an ability to go long and short, I think this environment makes a lot of sense right now, and it's a good, you know, perhaps diversification alternative for any portfolio.
Hey, George, just got about 45 seconds left here. What about commercial real estate, which has certainly been on a decline this year? If I look at the MSCI US REIT Index, certainly topping out like in early February, but we've seen quite a move to the downside. Are there distressed opportunities that you're investing into there? And again, just got now about 40 seconds.
Yeah, so we're not investing long in that market, but it terrifies me actually, because it's one of the markets that you know, we'll see an impact from this, and you know, not just because money's getting tighter and the economy is likely to slow down because of all these bank problems, but also just you know, the secular change with more and more people working remotely. So that's a sector that's certainly going to see more distress as well.
Is it another shoe to drop? 5 seconds.
I think it is. Okay. Good question, Carol. I think it is. Yeah, it certainly fits the mold.
All right. Listen, so appreciate your time. I know it's been a hectic week and another hectic day, but appreciate getting your perspective into this. George, be well. Take care. Have a good weekend. George Schulte, founder and chief executive officer at Schulte Asset Management, on the phone from Harrison, New York. The MSCI US REIT Index down 14% from early February.
industry because we have some headlines on Bank of America. Bill Ackman, activist investors saying Bank of America will buy the failed Signature Bank on Monday. That is not confirmed by Bloomberg, but we're certainly watching that. Shares of the struggling San Francisco Bank, First Republic, under pressure, under serious pressure, down 33%, and that's even as investors call that $30 billion cash injection from other banks a temporary solution for First Republic. And Credit Suisse shares under pressure. Reuters reporting the troubles have prompted at least 4 big banks to curb trading with the Swiss lender or consider doing so, and that includes SocGen and Deutsche Bank over counterparty concerns. There's some good news, though, for some of the smallest lenders in the nation. We get more on that part of the story, the brighter side, from Bloomberg's Dan Schwartzman. Dan.
Even with the recent failure of 3 banks shaking the confidence of depositors, community banks have seen an increase in deposits. According to Federal Reserve data compiled by Apollo Global Management, the percentage of insured deposits at smaller lenders is well above 60%. Community banks usually hold $10 billion or less in deposits. Economists are, though, monitoring local banks to see if there is a domino effect from the collapse of the 3 banks. Dan Schwartzman, Bloomberg Radio.
Thank you, Dan. And also FedEx shares, they are jumping right now. That's after FedEx boosted its forecast as cost cuts take hold. Looks like we are going to see FedEx be one of the stocks close in the green. And those are some of the company stories we're following this St. Patrick's Day. I'm Denise Pellegrini.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody. Yeah, this is Bloomberg Business Week on this Friday, March 17th. As you know, Tim is on leave. Carol Masser, along with Just Metten, here in our Interactive Brokers studio. And every week, we get a gut check on markets and business with former U.S. Treasury Secretary Larry Summers. So let's get to our Wall Street Week daily segment. Bloomberg's David Weston asking Summers what the Fed should do next week.
I think it would be very unfortunate if, out of solicitude for the banking system, the Fed were to slow down its rate of interest increase beyond what was necessary, beyond what was appropriate, given the credit contraction.
All right, that, of course, was former U.S. Treasury Secretary Larry Summers, now a Harvard University professor and a paid contributor to Bloomberg Television. You can catch that conversation with the former Treasury Secretary. You can find that on Bloomberg Wall Street Week with David Weston. That is tonight at 6 p.m. Wall Street time right here on Bloomberg Radio. It's interesting, though, Jess, you know, Larry Summers went on to say, I do think that the Fed should not allow financial dominance, a condition where a central bank doesn't dare to tighten its policy stance, as that would threaten the stability of the financial system. This is the quandary. But we know that initially, go back 100 years or so, you know, that was what the Federal Reserve was set up to do, in big part, was to make sure that the financial system worked well. This was after another bank panic. Here we are. We know it's got a dual mandate, and it's fight for inflation. So what does it prioritize?
And that's been the big question when I've been speaking with portfolio managers, Carol, because obviously, like you said, they have that dual mandate when it comes to maximum employment, price stability, especially the past year where inflation has been at decades highs. But then they also have that other job, right, when it comes to financial stability. So that's the debate that's been going on with my sources, is which one will be full front and center next week at the meeting? Is it the financial stability Fed, or are you going to be on the price side of things at that meeting, Carol?
Or does the Fed get an assist because of this, dare I say, crisis,
right?
And that could lead to ultimately a slowdown and a recession, and then some of that slowdown brings down inflation as well. So maybe the Fed gets a pretty big assist potentially from all that is going on. All right, we're getting ready to wrap up the trading day. Just about 2.5 minutes left in the session, and we've got yields near their lows of the day, and stocks the same thing. Time to head over to our TV colleagues. That's because Beyond the Bell starts right now.
And beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld. We're counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast. We're joined right now by the Queen, Carol Massar, Jess Menton filling in today for Tim Senovic. Welcome to our audiences across Bloomberg Television, Bloomberg Radio, Bloomberg Originals, and those folks streaming on YouTube. Wrapping up the week here, Carol, and really setting up for probably what's going to be even a more important week next.
Yeah, no doubt about it, right, with that Fed meeting. And it's funny, I was looking at the VIX because I was just trying to get a feel as we head into the weekend, you know, how that was playing out. We're right now at just below 26. You know, at our highs this week, we were up almost at 31. We're up just about a point today, and pretty much where we started the week, just a little bit higher. And I find that there is still, I think, a fair amount of complacency in this market, despite the week that was.
And I have to point out what's happening with the New York FANG index, so the NYSE FANG index, rather, it's up more than 9% this week. So that would be its best gain since November 2022. So you are still seeing investors, especially even though it was down a bit today, still investors more overall this week, Romaine, going into those more risky corners of the market like technology and growth.
I forgot all about the NY FANG index, Katie Greifeld. I mean, at some point it was deemed irrelevant, if not dead, but I guess it's back.
Is that still the acronym FANG? Have we moved on from that yet?
No, apparently everything old is new again
Shouldn't it
here.
be Mang?
I don't know.
It should be Mang.
Mang. All right, somebody get Ben Bernanke on the phone and see what he has to say here. We are waiting to hear from Jay Powell. Next week, of course, the two-day Fed meeting starting on Tuesday, the big announcement and press conference on Wednesday. We could hear from regulators even before we get to that day. All right, folks, it's been a wild week here, and now the week coming to an end. The Dow Jones Industrial Average lower on the day by almost 400 points, or about 1% here, erasing all of the gains for the week. It looks like it's going to finish on a weekly basis in the red by only about a tenth of a percent. The S&P and the NASDAQ are lower on the day, but we should point out higher on the week here. You hear the clapping and cheering, the folks over there at Jameson, very fitting here on St. Patrick's Day, and then over at the NYSE, you got the folks at Guinness here on St. Patrick's Day. Two interesting selections here for this particular March 17th. Anyway, the S&P 500 down 1% on the day, the NASDAQ down 0.7%. And of course, we know the Russell 2000 never really got any traction all week long, down 2.5% here on the day, down even more than that on the week. And of course, all of the banking index really taking it on the chin.
All right, time for the Bloomberg quiz. No, not exactly the quiz, but best name in the S&P 500 this week, guys?
It's got to be either NVIDIA or AMD. How about that?
You're so smart. Advanced Micro, it looks like. Up 18%. Worst performer?
Worst performer, it's got to be a bank stock, I assume.
Yeah.
First Republic.
First Republic,
Okay, there you
down
go.
almost 72%. All right,
I got it first.
The week that was.
It's not a jinx, is it?
Jinx.
I don't know. Well,
When
somebody
you say
buy
it
me a
together,
couple so we
yeah.
can just move.
Katie, help us.
Okay, let's look at the industry groups here, because I do have a little piece of good news. We do have one industry group that managed to fight its way into the
How
green.
about that?
Software and software services. Isn't that great? 0.2% higher. Food and
I feel like there
staples.
should just be like stars drawn around that or something. We need something.
Yeah, I'll work on that. I forgot my marker. But in any case, food and staples
It's an erasable
almost
board.
got there. Not quite. Telecom too. Then you look down the list. There is a lot of red. Right there at the bottom, it's the banks. Probably not surprising given the week that we had and given the price action that we saw today, Carol.
All right, so let's get to some of the individual gainers. FedEx, you know the story. We broke their earnings after the closing bell yesterday. FedEx off its highs at the close here, but still with a gain of about 8%. Number one gainer in the S&P 500 today. We know the company coming out and better than expected report. This resulted in a bunch of upgrades to stock price targets, including analysts over at TD Cowen, Citi, and Susquehanna. Remember, Stifel, yesterday, before the earnings, they did an upgrade. So talk about a good call, because this stock is up now, rallying 2 days in a row. All right, let's get to Google. This was popping up among the top in the S&P 500 and the NASDAQ 100 today. Feels like AI is back being talked about on Wall Street because UBS came out, affirmed its buy rating on the stock. They noted Alphabet's investments into integrating generative AI into its Google search results don't pose a significant risk to margins. So they had some other upbeat comments when it comes to AI specifically. And then NVIDIA, also top among the S&P 500 and NASDAQ 100, upgraded overweight from equal weight at Morgan Stanley. They write, the development of generational AI is too much of a mega trend to get distracted by tactical concerns. Price target up to 304, stock closed at 257 and change. This stock is up, 75% so far this year.
And I just want to add a couple too. You pointed this out the last simulcast here with the Bitcoin, the crypto stocks. Coinbase up 40% on the week. Marathon Digital up 53% on the week.
I don't know. What do you make of that?
I don't know.
Fundamentals.
What do you make of a NASDAQ 100? I mean, just to get to the superlatives here.
Yeah.
Up almost 6% on a weekly basis. Actually, the best week of the year for the NASDAQ 100, despite 3 bank failures and maybe another one coming down the pipe.
I don't
Jess,
know.
what do you got? Did anything fall today?
Well, I'll go with the decliners. And so not surprisingly, we're going to talk about banks. So I'm going to start off with First Republic. So you look at that down about 7%. If you look at, though, for the week, it lost a little over 70%, so that would have been its worst weekly loss on record, even as it came when you saw these large lenders yesterday try to come to the aid of this bank, still very pressured. And then I have to go next. If you're looking at the ADR for Credit Suisse, so those U.S. listed shares, they fell again if you're looking at that, and it's down about 7%. Sorry, earlier I meant to say First Republic down around 33%, but still, the Swiss bank, I mean, that has a key meeting when you're looking at, say, Credit Suisse as far as what's going to happen this week with that bank. So that's going to be really in focus. And then lastly, I have to also mention what's happening with the bigger banks. So especially when it comes to Bank of America, we are seeing that more broadly, that stock also falling. But also when it comes to a key thing that happened just recently in the last hour, Bill Ackman actually said on Twitter that potentially, when you're looking at Signature Bank, there could be a situation there, but still it hasn't been confirmed by Bloomberg News. So that's something else that's been happening as far as whether or not Bank of America could buy that. But again, not confirmed by Bloomberg News, but it is something that we obviously are watching very closely.
And a couple to that, keep an eye on the travel stocks. So most of the airlines, cruise lines, all down 10, 20% here on a weekly basis. But of course, we go into the yield space, and it was wild. I don't know what to make of this. Down 31 basis points here on the day. The entire curve right now back below 4% here, but the swings that we saw on a week-to-week basis, remember earlier in the week we actually saw the MOVE index actually hit its highest level since the financial crisis here. We haven't gotten the data for today, but that volatility was a big part of the story. And guys, it's a big part of the reason why you see so many people moving to the sidelines. It's not really just about the price action in and of itself, but it's about, well, if you can't actually put a price on anything, then, well, you just sit out the market.
Yeah, it's one of those, I'm out.
Yeah.
I'm out. I'm going to wait and see how this settles, and we'll see if we get some settlement, if you will, in that Fed meeting next week. Also have the Bank of England. We've got some earnings, too, but it's all about Jay Powell and company, and I do wonder, I love this idea. What was it? The hawkish pivot?
Oh, gosh. Here we go.
All right. I'm
going
into
to check
branding.
out for the next 2 minutes.
No, you're
Go
not.
ahead.
But what does the Fed do, right? How does it like make sure it doesn't create more nervousness within the market environment, but to say, hey guys, I got it. I know inflation's still a problem.
You know, I was thinking about this last night as the Northwestern Wildcats were beating up on Boise
Were you
State.
really?
And of course they got a big game coming up tomorrow against UCLA here. So yeah, it's something I'll chew on here as I'm watching my Wildcats advance in the NCAA.
You're going to be like, can we get another beer? But a hawkish pivot. Oh wait, what's going on with the game?
Should I do a hard pivot here back to the Fed?
Please.
I don't know. I do think it's really an interesting discussion that we've been having, that for really market calm that they should hike here. But then we were talking with Jeff Sherman from DoubleLine to start off our program, and he made the case that they probably will to keep with that inflation fighting reputation, but they probably shouldn't. They probably should pause when it comes to next Wednesday.
And that's been the big debate when I've been speaking with portfolio managers as far as which type of Fed are you going to have when it comes to this meeting, whether it's the financial stability front and center, or if they're going to be still on the inflation fighting side on when it comes to that dual mandate. So that's going to be the big question going into next week.
I just want to just also put a pin on this volatility that we saw this week. I was just looking at the final data for volume that we had this week, well above the averages. This was actually the most, the highest volume day that we had of the week here, with about 19 billion shares swapping hands, but we were like at 14 billion yesterday and 16, 17 billion on Monday.
Microsoft up almost 13% this week.
That's like its best day in like
2005, did I see? Like that since
that's crazy. 2015.
Like how, what is that about? Is that fundamentals or what?
Yes, actually yes, because we've had a couple people point this out here, that if you are looking to stay invested in the market, you're going to look for the companies with the cash flow, with the profitability, and as someone pointed out, with good management.
That's the thing. I mean, a Microsoft and Amazon and Alphabet, I mean, they are sort of fortresses here. They're probably going to make money in any environment, maybe not as much money as they were making, but money nonetheless. When you think about the cash flows, when you think about the balance sheets, it makes sense that that's your defensive play.
All right, so is it Jameson, Guinness, or just a good Cotron tonight?
I'm going to stay out of that one.
Not for all
I don't want to get in
spirits.
trouble, but, you know. Happy St. Patrick's Day, everyone.
Happy St. Patrick's Day. Stay safe, everybody. All right, that's a wrap for our cross-platform coverage, radio, TV, Bloomberg Originals, and, of course, YouTube. We will see you again, same time, same place on Monday. Walk outside, check out the skies of blue. Yeah, they're a little bit hazy here in New York City, but I'm thinking about that. Well, I gotta say, earlier this week, we want to get a little bit of a check on the retail space and consumer space. We did get a check on retail sales earlier this week. You might recall when we reported on U.S. retail sales falling last month after a surge in the prior month in January, suggesting consumer spending. It's holding up. Yep, we got that. But it is getting challenged by continued high inflation, which is something we know the Fed will be addressing just next week. So our next guest has a great vantage point when it comes to consumers. Back with us, Ken Hicks, Chairman, President, and CEO of Academy Sports and Outdoors, the nearly $5 billion market cap sporting goods company. Stock up roughly 20% so far here in 2023 and hit a record high yesterday following its quarterly update. He joins us on the phone in Katy, Texas. Ken, good to have you back with us. How are you?
Great, great. Thank you for having me, Carol.
Well, tell us a little bit about how things are going. And I want to, if I can, before we kind of drill down into your business, let's start macro. We've got this week, it feels unnerving, although you look at some stocks and they certainly outperformed. We're focused on the bank sector. What impact is any of this, if at all, having on you guys?
Well, I think it's one more pressure on the consumer. And while it may not be a pressure that they personally feel, it's one that makes them aware and more conservative about, you know, what they do with their money. And that's always a challenge when the customer is a little leery.
So you see customers then pulling back a little bit now?
Well, a couple of things that we're seeing. One is that they're more looking for more value. And so we're seeing our private label businesses, and when we do have a clearance or promotion, we're seeing that do well. And the other thing is we're seeing the consumers are focusing their buying on things that, you know, they really enjoy. And that's, quite frankly, helps us because, you know, we sell fun, and Lord knows the world needs more fun. And that's good for us, and people are being more discriminatory about where they spend their discretionary money.
And that's interesting specifically about discretionary, because that's been the whole debate, especially looking at how the equity market is performing and also what that means for the economy if consumers are spending more toward either discretionary or staples. What exactly are you seeing with your products as far as, have you seen any specific shifts toward either side of that recently?
Yes, some of the categories that had big pushes during COVID, like fishing, exercise equipment, have slowed down. They're well above where they were before the pandemic, but they have dropped off. But where we're seeing people, you know, getting out and buying are team sports. So the kids, the families are still enjoying games. Patio and barbecuing. They're out there trying to enjoy, you know, their backyard. Maybe they've got a staycation. And apparel and footwear. Those are some classifications where people are really focusing, and they're running ahead of last year.
Yep, I need some new footwear because my puppy's been chewing everything. Having said that, Ken, one thing I'm curious, how nimble are you guys in your supply chain and your inventory so that as you've seen the shift from what was going on in the pandemic to what is going on today, how able are you and how quickly to meet that latest demand by the consumer?
The good news is the supply chain is pretty much back to running normally, and we are actually pretty nimble. And we learned a lot during COVID and how we were able to operate, speed up the inventory, move things around, and you know, we are in good shape. And I think overall, retail is in better shape now because the supply chain is back to normal.
Does that mean pricing pressures are back to normal? And are you reining in? Are there prices you raised during the pandemic because you had to meet your margins?
We've been very, very thoughtful. We're a value retailer, and so we've had to be really careful. Prices have gone up. The cost of raw materials, cotton, steel, things like that go into our product, labor. And so what we've done is we've really focused on those key price points. For example, we've got a $99 adult bike, a $59 kids bike, a $499 folding chair. Those are all big categories for us. We're holding those price points, and we're working a little bit shorter than we would have historically. But we want to make sure we have that value, and we're being thoughtful of where we do take our price increases so that we don't hurt that consumer who's looking for value.
Ken, I'm from Texas, so I've definitely been inside those stores many different times. And I was curious, as far as when you're talking about these supply chain issues, obviously inflation, can you still keep the pace up to open new stores with everything that has been happening?
Yeah, we are, when you open a store, you're opening it for 20 or 30 years.
Right.
And there's an expression about you don't pass cars on a dry track, you pass them on a wet track. and so if there's a wet track, this is a wet track. And so now's the time to open so that when the economy comes back, we're well positioned and ready to go, as opposed to losing the time and when it does come back. And so the good news is our business throws off a lot of cash. We're able to support all these with operations. We're profitable. One of the things that we reported and why our stock reacted favorably yesterday when we reported our earnings were up, even with sales that were down more than what we would have liked. Our earnings were still up 11%, and we had a record earnings per share for the year.
So you're going to continue to open new stores. Are you slowing, though, the pace down at all because of the volatility we've been seeing?
No, we really aren't. In fact, if we could open more, we could. But one of the challenges right now is the building stores is a challenge. Getting the sites, the labor, all the fixtures is taking a little bit longer than it historically had. But we really don't see at this point. We're doing it. We're doing it in a conservative manner anyway. We're not going out willy-nilly. We opened 9 stores last year. This year we'll open 13 to 15. We've got our going out with our new annual plan, our new 5-year plan later this month.
Right.
And we'll talk about how many we'll be opening over the next 5 years. But we're positioning ourselves for the long term.
Is the real estate space cheaper? The spaces you want to rent out?
It depends. It depends on the market. Now, where we're looking are in some of the better markets. So some of the prices have gone up, but it's the real estate business isn't like it was 5 years ago, where things were a lot cheaper.
And are you still having to pay up for workers?
Yeah, we have taken our salaries up for the stores and for our distribution centers. We have not had a problem getting people because we offer a very competitive wage, and it's a fun place to work. Plus, you get a discount on good stuff.
I was curious about what you think that says about the direction of the economy if you're not having a hard time getting workers.
It's part of the Fed's challenge right now that they think they're trying to slow the economy down, and the economy is not slowing down that much. You just commented earlier about what consumer the consumer sales are still growing, and that's continuing.
Yeah, I wouldn't want to be the Fed right now, right? You're watching that Fed meeting quickly. Just got about 20 seconds.
Yes, we pay attention to what they do very closely.
All right, Ken, always good to get a gut check with you and really appreciate it. Ken Hicks, he is Chairman, President, and Chief Executive Officer at Academy Sports and Outdoors, joining us on the phone from Katy, Texas. Just taking a look, as we mentioned, stock's up about 20% so far, and we certainly did see some movement in the stock as a result of its earnings, a record high following that quarterly update. So investors like what they heard.
They definitely did. And
what do you buy from a store like that?
Right. I mean, he brought up the fishing equipment.
Are
I
you
have
fishing?
I have tons of friends that do that in Texas. So
Not
definitely,
you? Do you
that's
fish?
I mean, yes, I do.
All right, good to know. This is Bloomberg Business Week on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 4:20 on Wall Street. We check the markets all day long for you here at Bloomberg, and a rough end to a tough and crazy week on Wall Street. Stocks closing lower on continued bank worries, even in spite of that $30 billion cash injection that First Republic is getting. Shares of First Republic, they plunged 33% today. There's also talk that Bank of America might buy Signature Bank. At least that's what activist investor Bill Ackman is tweeting. He says he's hearing that will happen Monday. Bloomberg does not have that confirmed, I should mention. And of course, we're all watching Credit Suisse. It was under pressure again. The ADRs were in U.S. trading today. It fell in Europe as well. At least four major banks, including SocGen and Deutsche Bank, have apparently placed restrictions on their trades involving Credit Suisse or securities because of counterparty concern, according to Reuters. Now, SocGen kept existing counterparty positions with Credit Suisse, but isn't increasing them, according to what some people say. So that's something we will be tracking for you all weekend long. And with that special edition of Bloomberg Daybreak Asia coming at 5 p.m. Wall Street time on Sunday night. For now, let's check the markets. The Dow down 385 points, let's call it. That's about 1.2%. The S&P 500 down 44 points, 1.1%. The NASDAQ down 87 points, 0.7%. The yield on the 10-year, 3.42% right now. We were a little lower earlier, but still not exactly, an endorsement of Fed hiking rates a lot more soon. NYMEX crude right now down about 3% on the day. Spot gold up just about as much, up almost 3%, and FedEx shares gaining almost 8% on the day after it cut costs and boosted its forecast. And that is a Bloomberg Business Flash.
All right, Denise, thank you so much. Denise Pellegrini. Bloomberg Business Week, you are watching and listening. Carol Master along with Jess Matten, brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Excuse me, your small to medium-sized business could be missing out on an opportunity to claim the employee retention credit. Innovation Refunds has helped thousands of small and medium-sized businesses claim over $3 billion in ERC refunds and may be able to help yours as well. To learn more, just head to getrefunds.com. Well, I got to say, another great economic indicator I always feel is anything and everything to do with transportation and the moving of things around in our global economy. So with that in mind, FedEx has certainly been on our radar today. The stock jumping the most in, I think, about 9 months, a two-day rally of roughly 15%. It got an upgrade yesterday ahead of earnings. And then on that quarterly update, the company boosting its profit outlook and more. So let's get to it. We've got a roundtable. Bloomberg Markets correspondent Kriti Gupta joining us via Zoom in New York City. And this has been on her radar. She's been like, hey, guys, don't forget FedEx for the last 24 or so hours. And then also with us is Anthony DeRuyter. He's senior analyst covering the company over at Third Bridge. He's on the phone in New York City as well. Kriti, let's kick it off with you. You did give us a heads up, I feel like 24, 30 hours ago or so, ahead of FedEx. Big rally in the name. Tell us about the quarter and why the stock shot up so much.
Yeah, Carol, to your point, I've been really annoying about it because this is a really big deal. I think a lot of the spotlight has been on, obviously, the banking crisis. But look, at the core of the issue is this idea of inflation. I think FedEx is such a great story to kind of talk about it. We think of FedEx as this bellwether stock. If shipping activity in the United States and around the world slows, that must mean the economy is slowing too. Well, this time around, look, we know that consumers have been spending just a little bit less. The economy is slowing, perhaps not to the extent of panic, but slowing nonetheless. And that really showed up in FedEx's quarter here. The estimates going into those numbers after the bell yesterday was that they were going to see a pretty substantial volume decline and therefore a profit decline. And that's exactly what they saw. A volume decline of about 6% across the board and then a revenue miss. And ordinarily, when you see those kind of stats, you would think, well, the stock should drop, right? The investors should kind of punish the company for missing their earnings. But it was their cost-cutting measures that rescued the stock. The idea that they are going to be cutting headcount by 25,000 people by May. And that's on top of the 10% headcount that they were already going to cut that they had announced in February. Now, it's really important to put that into context because FedEx has about 191,000 employees.
So that's a lot of workers. That's a lot of workers.
Yeah, that plus no buybacks, so equals cost cutting.
Right. Anthony, I want to bring you into the conversation because, as we know, FedEx has been cutting costs already. And we did get news in December about that additional $1 billion in costs. And so there are smart and productive cost cuts, right? And then there are cuts that aren't necessarily going to mean anything. Help us out here make sense of it.
For sure. Thanks for having me, guys. So, everyone's focused on those cost cuts over in labor. I think, the people we speak to say, look, this is a short-term P&L boost, and it makes sense, right? You cut costs over in labor, and that helps out the P&L. But one thing that they point out is, what does this do to the company long-term when it comes to attrition and productive labor going out the door following that labor that's just been cut, right? I mean, FedEx is a place where they bleed purple, and there's this big culture of people come first, especially under Mr. Smith before Raj. So now you're doing the opposite, and people are from what I've heard, from what we've heard, is there's now this fear that eats into the productivity outlook, which could hit FedEx moving forward. And then, outside of labor, we've got to think about, look, they're talking about $1 billion in permanent cost cuts this year and then $4 billion under drive next fiscal period. Where are those costs going to come from? Because based on what we're hearing, a lot of that implementation is going to be really difficult, because where do you find those costs that you can actually take out without sacrificing something else?
Kriti, I'm curious about when it comes to air fleet. What's happening with that?
Do we lose Kriti? All right, we're going to go back to Anthony. Hey, Anthony, though, Kriti was kind of actually even nudging us about, a smart thing to look at is the air fleet. So what are we seeing, Anthony, when it comes to FedEx's air fleet?
Absolutely. So that's actually the big one. Our network says that if you're going to look for where to get your biggest cost cut, your biggest bang for buck with FedEx, it's going to come from your air fleet. I mean, you permanently cut a plane out of the fleet, you're saving yourself up to tens of millions in annual recurring OPEX, right? And, I think that makes sense given what we saw from FedEx yesterday in their call. They talked about how this year they're going to try and phase out, or at least begin the process of phasing out their MD-11s and taking this delivery of these more efficient, better unit economics 767s and 777s. Now, can you actually do that? And, what we're hearing is that's really hard, because you have things like minimum flying hours for the pilots. They're not going to be happy if you're basically taking out capacity and trying to take away their minimum flying hours. And secondly, you put at threat the air slots, the landing rights, right? And that's a long-term potential loss. And I guess one place you're going to see FedEx ideally not do that is Trans-Pacific. That route is way too important for them. So where else can they do it?
Well, Anthony, I got to jump in here and ask about the strategy that FedEx has used. We know that they had this massive warning that I think tanked the whole market last fall in September, I believe. But at the same time, when they're competing with the likes of UPS or DHL, for example, FedEx didn't hike their prices when UPS and DHL did. They really invested in the headcount. Do you think that's coming back to haunt them a little bit here?
Well, I guess so, because you're starting to see that obviously FedEx is reversing that capacity increase on the labor side, right? Which obviously when you go wishy-washy with how you're treating your labor and your headcount, that doesn't send a great signal to the market. It sort of implies some sort of strategic misdirection. And also, I mean, you're seeing now that with this 2023 GRI of 6.9%, which was matched by UPS, by the way, now they're trying to hold on to yield as volumes come down. How successful will they be with that? Because we know, for example, that FedEx is not as strong as UPS in the SMB segment. That's part of, UPS's sort of, first off, I guess better, not bigger, now better and bolder strategies to focus on that higher returning customer segment. If FedEx isn't there, it means that they don't have the same quality of revenue. And if they're not getting that same, I guess, quality of revenue and what that means for margins, it means they have to take, I guess, capacity out of the system. And as we pointed out just now, that's really difficult to do.
Kriti, I wanted to go back to you because, as you know, in September, FedEx did issue that profit warning due to declining packaging volumes around the world. What changed since then?
Absolutely nothing, actually. Look, they are still getting package volumes across the board, are seeing declines in their express unit and their ground unit, even their freight unit. They've made that very, very clear. I think the issue here more is, why is FedEx no longer being seen as this kind of global bellwether? And I think the answer to that is, look, it didn't necessarily tank the market or have any effect on the market. I don't think that's just because the spotlight today was on kind of the banking crisis. I think it was because FedEx is dealing with a lot of the same issues that a lot of other companies are dealing with. It's the inflationary cost at the end of the day, and that's kind of skewing the results when it comes to just how much profit and activity FedEx is seeing.
Yeah, and maybe perhaps telling, despite FedEx's rally, UPS down about 0.6%. So, Anthony, just saving last words for you, got about 30 seconds. What are these companies telling us about the outlook?
Yeah, look, the role for FedEx as a bellwether, I almost take it the other way. I mean, we're hearing that you got to look at ocean freight and what's happening there to figure out what's going on with FedEx and their volume outlook, which, by the way, we're thinking mid to high single digits drop. I think you've got to people have to be dialing into this April 5th call on Drive just to see how long, I guess, how much legs this run has with regards to cost cutting. Volume outlook, what it is, it's going to have to come from costs. And as I pointed out, there's a big question mark there. Can they take more out of costs, especially against this declining volume outlook?
Yeah, running a business just on cutting costs. I mean, I'm just thinking, get an MBA, like that's not how you do
Right.
it. But interesting, and we shall see. All right, going to leave it there. Anthony DeRuyter, senior analyst over at Third Bridge, and our own Kriti Gupta, markets correspondent at Bloomberg, with that great heads up on FedEx. All right, right now, back to World and National News, off to our 11:30 newsroom, and Leslie Lotto. Hi, Leslie.
Hi there. There are reports that former President Trump could soon be fingerprinted and photographed for a mugshot. However, Trump is undeterred, attacking prosecutors pursuing various cases against him.
Whether it's the Mar-a-Lago raid or the Unselect Committee hoax, the perfect Georgia phone call, it was absolutely perfect, or the Stormy Horseface Daniels extortion plot, they're all sick.
The AP reports security preparations are underway in New York City for a possible indictment. The Democratic Manhattan DA appears ready to elevate the false paperwork case from a misdemeanor to a felony. The feds earlier declined to indict Trump on the charges of alleged hush money payments to porn star Daniels. Former president has denied any affair with her and allegations related to any hush payment. President Biden celebrating St. Patrick's Day with Irish Prime Minister Leo Varadkar and House Speaker Kevin McCarthy at an annual Friends of Ireland luncheon on Capitol Hill this afternoon. President Biden agreed with McCarthy's call for bipartisanship in Washington.
That's the power of friendship. I think it's the power of, that's the strength of our partnership if we work at it. And simply put, I think it's the Irish of it.
The two's remarks were notably bipartisan today. Retired Air Force officers stormed the U.S. Capitol January 6, 2021, wearing combat gear and carrying zip ties. In the Senate gallery, sentenced to 2 years in prison. Larry Brock also got 2 years of supervised release after prison and 100 hours of community service. He refused to speak in court. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 4:40 on Wall Street. We check the markets for you all day long at Bloomberg. Bank problems giving us kind of an early St. Patrick's Day hangover today. You know, we had that great comment from one of our guests this week saying it's investors that are stress testing the Fed instead of the other way around. And there certainly is a lot of stress on Wall Street and a lot of questions about the Fed will do next week. Shares of San Francisco-based First Republic, they plunged almost 33% today, and that's in spite of that $30 billion cash injection that they are getting. That is, the New York Times reporting that First Republic does plan to raise more cash by selling shares privately. Activist investor Bill Ackman, meantime, tweeting that he is hearing Signature Bank will be bought by Bank of America on Monday. We don't usually cover random tweets, but that's a big one. Signature, of course, in U.S. receivership after being seized by regulators last weekend, so we're monitoring that as well. And then the drama at Credit Suisse continues to unfold. Could have developments on that over the weekend for sure. Counterparties now, apparently, according to Reuters, either halting business or considering halting business because of worry about counterparty risk. And George Goncalves, he's head of U.S. macro strategy over at MUFG. Well, he says banks are just going to face more upheaval before it's over.
All throughout the start of the Fed hiking cycle. This is what happens when you raise rates and you have a vehicle that can actually pass it through, and the banks weren't passing it through, and that's really the challenge. And so, I think rates heading higher or staying where they are even would still continue with this phenomenon of migration out of banks into the money markets.
Yeah, out of banks into the money markets, and that's one of the things that banks are certainly dealing with. Right now, the Dow down on the day, 1.2%, down 385 points. The S&P 500 closing 1.1% lower, 44 points. The NASDAQ down more than 0.7%, down 87 points. The yield on the 10-year, 3.43%. NYMEX crude, it fell about 3%. Spot gold, getting about 4% right now, giving us a little bit of green this St. Patrick's Day. And also, Maryland women's basketball team has just defeated Holy Cross, advancing to the second round. And that is a Bloomberg Business Flash, Carol.
All right, really appreciate it. Denise Pellegrini. Well, I don't know about you all, but I'm thinking about big time after this week, heading home for my pizza and wine.
Definitely.
Right. Are you ready to go?
I know I am.
Safe to say the pandemic made so many of us lean in big time when it came to food in our homes. Much of that has stuck around. And this really relates to our next guest. Let's get to it with Amanda Hessler. She's founder and co-CEO of Food 52. The company describes itself as a next-generation cooking and home company. It was one of Fast Company's most innovative companies for 2022. Amanda, an author and former food editor over at the New York Times. She joins us via Zoom in Brooklyn, New York. Amanda, really psyched to talk with you. Hey, tell us about your company, exactly what you all are doing.
Sure. Hi, and thank you so much for having me. So Food 52, we started back in 2009, actually in the middle of a recession. So these moments are feeling very familiar. And, we wanted to create this world that connected all the parts of your life that food touched, which we felt like was really vast. It was like food has a, impact on how you live in your home, the furniture you buy, where you shop for your groceries, where you travel, how you entertain and spend time with friends. And we wanted to, create a company that supported people in this area of their life. And, we've grown the business, brick by brick over the years. And, we've really expanded across the home. And so that's why we call ourselves now a cooking and home company.
All right. So online, social platform, you've got kitchens, help me understand the infrastructure.
Sure. Yes, I know. It's complex these days, right? So we actually are about to open a new office in the Brooklyn Navy Yard where we'll have something like 8 or 10 kitchens where we'll be, testing recipes, doing videos, creating photography. We also develop products there. We'll, photograph all of our products there. But we also have a whole network of creators, not only around the nation, but around the world, who create videos for us, recipes for us, articles, and just in our effort to really cover this really big landscape of food.
So you have
course, we're on TikTok and we're on, Pinterest and Instagram and YouTube. And, we have lots
So
of
yes,
shows.
yes, and yes, right? Like to all of it.
Like any modern media company, we're everywhere. Because we meet our audience where they are.
Well, are you a media company? Are you a food company? Are you a retailer?
We are this is why we say we are a cooking and home company, because yes, we are partly a media company, but we are also very much a commerce company. Commerce is the vast majority of our revenue. But the sort of business model is matters to kind of like under the hood us and investors. But what matters most to us is how we're serving consumers, right? And we feel like actually that's where we have innovated, because in the past companies have tended to be either a media company or a retailer, where in the category of food and home, like, you need both of those together, right? You need inspiration and ideas and information, and then the products that help you live better. And so we are just essentially integrating all of that into one company.
Okay.
So I know you have a subscription-based model. Walk us through exactly how this works. If I wanted to do this, how does this process work?
So you don't have to subscribe to be a member of our site. We're community driven. So anyone can become a member of our site, and you can, receive our emails, and, you can become, a VIP member, and, but you don't have to pay to be a subscriber.
Okay, so then how do you guys make money? Forgive us, I think we had some information that you guys had a subscriber model to your business.
Sure. So, and that's, it's actually something that, we talk about a lot, and something that we may work toward. But we're not there yet. The way we make money is we have brand partnerships, which is kind of more traditional advertising, and we make and sell products. So we sell everything from, blenders to table linens to, plates to tools to, candles, laundry goods, storage and organization. And actually, so that's Food 52. We also own two other companies. One is called Schoolhouse, which is a home furnishings company. It's known for its lighting and hardware, and Dance, which is a heritage home brand that is focused on tabletop and cookware.
Something I was curious about is coming out of the pandemic. Obviously, in the pandemic, people were cooking from home. Then everybody was eager to go out and eat at restaurants. But then things got very expensive due to inflation. Yeah, exactly. How has that affected your business? And are you seeing more people coming back in because of high prices?
Yeah, we definitely are seeing, seeing a desire for content about how to eat on a budget, and how to. And there had already been a movement towards reducing food waste in people's kitchens, and I think people are now much more aware of that, right? Because every stalk of celery counts, because it's more expensive, or every egg in the carton counts. And so we've always, as a company, I think when you're in the food space, first of all, you're constantly kind of adapting to the seasons. There's different foods in different seasons. There's lots of holidays through the year that you're cooking differently for. And so that's been kind of part of our DNA, is kind of reacting to what people are thinking about and anticipating what they will be thinking about in the near future, and then serving them. And so I would just say it's gotten magnified over recent years. When the pandemic first hit, it really was this moment where in many ways it validated our mission, that we are here to support people, right, and help them eat better and live better. And it was something we could literally really tangibly do at this moment when so many people needed help.
Amanda, one last question, because we're running out of time. I've only got about 30 seconds. Are you seeing any trends that consumers are getting a little bit more cautious in this environment? And just quickly.
I would just say that, people, yes, are definitely aware that their grocery bill is going way up. They want food to go further. They need help, knowing where they should be shopping, what they could be looking for, alternatives to more expensive ingredients. How do they bring, if they're not eating out as much, how do they bring that experience home? And that's really what we're here to do.
Well, really cool stuff. And hopefully we can check back with you again in the future. Amanda Hesser, founder and co-CEO of Food 52, joining us via Zoom from Brooklyn. You can check out more on their website. Just search on Food 52. But I do feel like this merging of food, home, right? Like this kind of one-stop shopping makes sense.
Right, and especially because we thought that would have been over when people were coming out of the pandemic, but apparently not, Carol.
Some of it's still continuing. All right, this is Bloomberg.
your company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters, I'm Denise Pellegrini. We had shares of First Republic absolutely plunging again today. That's even after the $30 billion cash injection it's getting from other banks. The stock slid almost 33% today. New York Times reporting First Republic is now in talks to raise money from other banks or private equity firms, could issue new shares, and also a full sale of the bank is also possible, according to one of the people to the New York Times. And a week after the run on Silicon Valley Bank, that bank's now former parent company has filed for bankruptcy for dealing with a recall. Bloomberg's Dan Schwartzman has more on what's happening at the automaker.
Around 1.2 million Ford Fusions and 100,000 Lincoln MKZ sedans made between 2013 and 2018 could have collapsed fluid hoses that may slow down the rate of deceleration. The National Highway Traffic Safety Administration says owners of the affected vehicles will be notified by mail sometime in mid to late April. Back in August of 2020, Ford had a similar recall where nearly 500,000 Ford Edge and Lincoln MKX SUVs were recalled with similar issues. Dan Schwartzman, Bloomberg Radio.
All right, thank you, Dan. And those cost cuts, including job cuts, appear to be working for Federal Express. Shares closed almost 8% higher today. The company boosting its forecast and saying lower costs are helping it balance its books, even with the number of packages it handles dropping. FedEx profit beats forecast and it's boosting its profit prediction for the year. It also expects a boost from its general rate increase. You're going to be paying more for those packages. So those are some of the company stories we're following this hour. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise, thank you so much.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
All right, everybody, more Business Week to come in just a moment. First up, though, let's get back to world and national news. Leslie Lotto in our 11:3 newsroom in New York City. Hey, Leslie.
Hey there. Multiple media outlets reporting former President Trump could soon be indicted. And in fact, security is supposedly being beefed up here in New York City. But the former president's unfazed. The Associated Press is reporting Trump may be indicted by a Manhattan grand jury related to hush money paid to women that is, who had said that they had sexual encounters with Trump before he was president. Trump also posted on Facebook today for the first time since 2021, simply saying in all caps, "I'm back." President Biden says Congress should get tougher on failed banks and allow regulators to impose tougher penalties. President saying the strengthening of accountability is an important deterrent to prevent mismanagement in the future. He says options should even include clawing back compensation for negligent executives. Could it be that coronavirus actually did come from that market in Wuhan, China, after all? International scientists have reportedly examined genetic data not previously available. Samples come from the Huanan seafood market and may be linked to raccoon dogs. A French scientist scouring a database came upon data which the World Health Organization Director General said today could move us closer to a definitive answer on the virus's origins. And the former police officer in Minneapolis, Derek Chauvin, who's in prison for murdering George Floyd, has more trouble on his plate. He was convicted in Floyd's death in May of 2020 and now has admitted that he hid tens of thousands of dollars from the state of Minnesota. The disgraced former cop pleaded guilty to tax evasion today. He was charged with his ex-wife for ripping off the state just after Floyd's death. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto, and this is Bloomberg.
All right, Leslie, thank you so much. As you know, March is Women's History Month. Every day this month, we've been celebrating significant moments in women's history. So let's get your installment for this Friday, March 17, 2023. For that, here's Bloomberg's Lisa Mateo.
On this day in women's history in 1969, Golda Meir is elected as Israel's first female prime minister. She took the position after the sudden death of Prime Minister Levi Eshkol, making her the country's fourth prime minister. Meir was born in Kyiv, Ukraine, and raised in Wisconsin. She worked as a teacher and Zionist labor organizer before heading into